If there weren't controls and little checks in the system, then someone somehow would find a way to take advantage of the system and get a little bit of cash in their pocket. And of course, because people have done this in the past, we have set up internal control systems that will protect our assets, promote efficiency, follow policies, and make sure all accounting is reliable. Managers and auditors are required by the Sarbanes-Oxley Act to confirm internal controls. Some of these rules are that auditors will be monitored by the Public Company Accounting Oversight Board. These auditors are going to evaluate if a company's internal controls are working effectively. And serious violators of the Sarbanes-Oxley Act, depending on the severity of the crime, can lead to heavy fines and up to 25 years in prison. There is a set of internal control principles that all businesses should follow. First, a company will clearly define roles for its employees and assign each task to one individual. There should be no overlap in who does what because this gray area can lead to problems you do not want to be having in finance. Second thing a company will do to make sure all operations are going smoothly is record keeping. These records should be up to date, transparent, and honest. Employees that are handling assets should be bonded to discourage theft and insure those assets. Buying an insurance policy against theft by that employee who is managing the assets will bond them and ideally will deter any theft or mishandling of the asset. But that employee who is handling the asset cannot be the same person who accounts for that asset. The person who accounts for the physical inventory, for example, cannot be the person who accounts for inventory because they can change around the numbers to hide something nefarious. Another way to check people within a company to make sure nothing sketchy is going on is dividing responsibility for a transaction. The separation of duties takes the task and divides the responsibilities, but does not duplicate its work. For example, one employee will request for inventory, but the second employee needs to approve the request, and someone else will be responsible for paying for that inventory. And at the end of it all, a different person will record this on the books. This one transaction for inventory was divided between 4 people, but this separation reduced the risk of fraud. Internal controls have improved dramatically with the advance in technology. So a lot of businesses now apply technological controls, not only just to internally check the company, but also because it can automate a lot of work. The last principle of our internal controls requests that routine reviews are taken to make sure all these principles are carried through. Auditors will be the ones responsible for going around and checking that the business is upholding the company policy. All these controls were put into place because people have tried to take advantage of the system, and there are 3 factors that will drive a person to commit fraud. First would be the opportunity to commit the fraud with the least amount of risk of getting caught. The perp has to think they can commit fraud and get away with it. Next is pressure. That is the stressor or the desire that is driving that person to commit fraud. And lastly, the person who is committing fraud has to be able to rationalize why they are doing it. They have to think that it is okay that they are committing this crime or that it is necessary, which is why they are doing it. This is going to be known as your fraud triangle. A term that will be thrown around that you might not know yet is liquidity, and this measures how capable a business is of paying back its current obligation. To simplify it even more, how quickly can that business convert its asset into cash to pay back its liabilities? Cash and cash equivalents are about as liquid as it gets because you can immediately use them to pay back your liabilities. These are going to be referred to as liquid assets, and they're going to be at the top of your balance sheet. When you are listing your accounts on your balance sheet, you're going to go from most liquid to least liquid asset. Although cash is our most liquid asset, we have to watch it like a hawk because it can be easily tampered with and hidden. So the treasurer who manages the cash has to be very responsible with how they handle our asset. Typically, collecting the receivables is of top priority because the quicker they pay, the more cash you have readily available. That is why sellers offer a discount in their credit terms to their buyers. That way, their buyer feels enticed to pay back sooner. But a lot of businesses will also wait till the very last day of that credit period to pay back their liabilities because they want to keep that cash for as long as they can. With the cash the business does have readily available, it is important they plan how they are going to use it to make sure every dollar is being spent wisely. And then whatever excess cash the company does have, might as well make it work for you and invest it. Go to any retail store where there is a cash register that you will be rung up at, and your purchase will be recorded on a receipt. Unfortunately, it is bound to happen, but the money that is in the cash register will not always be equal to what the cash receipts are saying. Because we do not want to over or understate assets, the difference between what is in the cash register and what the cash receipts show will be recorded in the cash over and short account. If your cash register is short of what it says on the receipts, then you will debit this account. But if your cash register is over what is shown on the receipts, then you will credit this overage. A lot of times customers are given too little change, so this account will typically be a normal debit balance that we will record on the income statement under miscellaneous expenses because ideally it is a small balance. The petty cash account will also ideally have a small balance because you will only ever use this account to pay for tiny fees that you don't necessarily want to use a credit card or write a check for. Like if I bought a $4 pen on some random Wednesday, I don't want to have to write a whole check to record this company expense. So instead, I'm going to use the petty cash fund. The business will deposit an estimated amount of cash into this account that they can drain during a short period. So I would drop $50 in my account to last me 2 weeks in case I need the spare cash. To open a petty cash fund, I would need to credit the amount of cash I want to deposit into this fund and then debit my petty cash account. Now I will not touch this account again unless the amount in the fund is changed. So let's say I put $50 in my petty cash fund and within 2 weeks I spent $42 on random supplies and parking spots. To record this, I would debit my miscellaneous expenses and credit my cash account. At the bottom of our journal entry in our little blurb, we will say we reimburse petty cash, which just means we replenish the fund after using some cash to pay for these small expenses. Since we are estimating how much cash we plan on using in this petty cash fund, sometimes our estimation will be off and we need to either increase or decrease our fund. To increase the value in our fund, we will debit petty cash and credit cash. To reduce the petty cash in our fund, we will debit cash and credit petty cash. So we all know at the end of the month, your bank is going to send a bank statement that is going to reflect your account's activity for that month. Your bank statement will show the beginning of period account balance, all decreases and increases to that account, and then the end of period account balance. On your bank statement, you might see some canceled checks, which are checks the bank paid and subtracted from the account. You'll also see any bank service charges, uncollectible checks that were deposited to the account, ATM withdrawals, advance payments, and any corrections to banking errors. Your accounts may also earn interest, so this will be shown on your bank statement as well. Balance on the bank statement rarely matches the depositor's records, and that's not because one of them is wrong, it's just because of timing differences. The difference in the company's cash balance on their records and then on their bank statement will be explained in the bank reconciliation. Your bank reconciliation will be prepared by someone who did not handle the cash, that way we are reducing the risk of fraud. To match up our balances, we are going to adjust both the book balances and the bank balances, but separately. In a bank balance adjustment, they will fix items that the business has already recorded, but the bank hasn't yet, or it made an error when recording. If a company already recorded on its book a deposit, but the bank has not yet processed it, this is known as a deposit in transit. So if the account holder deposits a check in the night when the bank was closed, it's going to reflect on their records, but the bank has not yet recorded on their end. Deposits in transit are added to the bank balance during reconciliation. My business can write a check and record it on my books, but the payee hasn't cashed it in yet, so technically the cash has not left my account, even though we record this as a credit to our cash account. This is known as an outstanding check, and the bank will need to subtract the total of that outstanding check from the bank balance in its adjusting entry. If the bank made an error in recording an amount for a check or deposit, the bank side of the reconciliation will be corrected and shown on their books. If the bank already records something on their end, but the business has not yet shown it on their books, they need to adjust their book balance with an adjusting entry. All unrecorded cash receipts and any interest earned are things the bank automatically records, but the company may not know about until they get their bank statement at the end of the month. So these items will need to be added to the book balance. Banks also deduct fees like service charges or penalties. When a person writes out a check, they need to make sure they have the money available in their account, and if they don't, then the check bounces and is recorded as an NSF check. This will reduce cash in your account, so on your books, we will subtract all NSF checks and bank fees. Just like a bank would, if a company records something wrong on their end, they fix these mistakes on their book balance. Your true cash balance should be equal on both sides after your bank reconciliation. To see how quickly we can convert our accounts receivables into cash, we are going to compute the days sales uncollected ratio. This will assess the liquidity of your accounts receivable. So take the balance of your accounts receivables and divide that by your net sales. Remember, net sales is found by taking your sales minus discounts, returns, and allowances, which we went over in our earlier video on merchandise inventory. Take your quotient and multiply by 365, and this will tell you how many days it should take you to collect cash from those receivables. A lower number is obviously better because this means you're going to get the cash sooner and you can then use it to pay for your obligations. So that sums up the basics of cash fraud and the controls a company puts into place to protect their assets. Now, of course, go down below, check out my free downloadable study guide and practice worksheet to help you study this. And don't forget to subscribe for more lessons on accounting.